In the September quarter, all the attention was focused on the US, be it the race for the White House, Clinton versus Trump, or the Federal Reserve, and would they actually raise rates for the first time in 2016. To our mind, as investors, however, the real attention was focused elsewhere. In July, for the first time in 2 years, all Australian assets went up together. Australian equities, Australian REITs, Australian bonds, and the Australian dollar, following the post-Brexit depression around the world and yields decreasing. However, for us, the big event of the quarter happened just before September end, when finally, after many times of discussion, the OPEC nations agreed to cut oil production, led by Saudi Arabia and Iran, and oil prices rose close to $50 for the barrel for the first time in 18 months. Following their strong performance in July, Australian REITs and Australian fixed income no longer look so attractive going forward on a valuation-driven asset allocation framework. They used to have an advantage compared to other developed market assets. They no longer have that valuation advantage. Where we feel the best opportunities lie now in the asset class universe are definitely the emerging market space. We prefer emerging market equities over their developed market equivalent, and we continue to prefer emerging market bonds, the government rather than the credit space, over the global bond universe. Going forward, the one sure thing is that markets will fluctuate. I think particularly this quarter, where we have the US election in November and the potential for a Federal Reserve decision on rates in either November or December, it is clear that there'll be market volatility. This will be exaggerated by the fact that most asset classes are still very highly valued or very expensive at this particular point. In this environment, we will continue to use expensive assets like Australian REITs, Australian fixed income, and US equities to fund further exposures into the assets that we feel are relatively cheaper, like emerging market equities and emerging market bonds. Carefully watching the currency position, where we feel right now the Australian dollar is broadly fairly valued and should be neutrally hedged compared to global exposures.